Is it harder than ever before in terms of investing in venture funds?
It's gotten a lot more difficult for a lot of reasons.
This is Ryan Akkina. He is a member of the global investment team at the MIT Investment Management Company with an AUM of over $30 billion. For the funds which are working really well, what are the reasons that they go sideways?
Frankly, if people have the spell of success, sometimes they become arrogant, right? They start to make worse decisions and treat people worse. When things are going well, you're never as smart as you think you are. And when things are going poorly, you're never as dumb as you think you are.
For managers who are contemplating raising today, what would be your biggest piece of advice?
I think you have to treat the process like...
Ryan, I am so excited for this. I love that you're here. So thank you so much for joining me today.
My pleasure. The tables are turned now.
The tables are turned now, so this is going to be fun. The LP world is an interesting one. How did you make your way into the world of fund investing and being an LP and come to be at MIT?
Well, it's definitely not a job that you think of as a kid or something and say, I want to be an LP, right? I mean, I didn't even know the job existed probably till my early 20s. Not to be too meandering, but maybe to explain a little why I got interested in technology as well. Originally I thought I would be an engineer, and I was lucky. I had this interesting job in high school where I worked at HP and Intel working on microchip design on this project called the Titanium processor. And so I assumed when I went to college, I'd probably do double E and, be an engineer after that. But I wound up at Stanford and started in double E. And about 4 summers into my internship at HP and Intel working on this processor, I decided I didn't really like working as an individual contributor engineer in a cubicle somewhere and wanted to do something different. So I switched to something at Stanford called Management Science and Engineering. In retrospect, maybe what I should have concluded is I just didn't like working at a big company. But anyway, I did that, and I was also part of a lot of entrepreneurship activity at Stanford, if you will. There was this club called Bases that helped organize the career fairs and speaker series and things like that. So I got to meet a lot of interesting VCs and entrepreneurs through that. Got to work with some interesting firms as well. This was back before YC was so well known, for instance. And I remember one spring, I think, we helped organize a YC startup school event on the Stanford campus. So I got to see that from pretty early days. So, I actually, when I was graduating, I thought, well, maybe I'd like to become a venture capitalist. And I also started a company with some friends my senior year that a few months in, I decided it was unlikely to work out, so I didn't stick with it. They actually went on with it for 4 or 5 years, I think, and went through YC and made a go of it. But anyway, I actually thought about becoming a venture capitalist after school, and I had an offer at a firm, but I ended up deciding, I don't really have a right to win there, right? I had seen by that time that the returns were pretty concentrated in just the top people, right? And not having been an entrepreneur or even, a senior executive or something at a tech company, I just thought, well, is this really the best thing for me to start off at 22 and just carry someone's bag and probably not be very much value add? So, but then inexplicably, I decided to be a management consultant instead. So I did that for about a year, and it was a good experience. I learned a lot, but about 6 months in, I could already tell I didn't want to do that for the full 2 or 3 years that you typically do it as an analyst. And I remembered I'd been interested in investing from seeing venture capital, and obviously I still didn't have a good reason to be in venture capital. I thought, what else can I do to learn about lots of different types of investing, and where could I work for a good cause as well? And so that's how I got the idea of working for an endowment or foundation and learned about this whole LP world. And it just happened that MIT had a job posting on their website, so I applied to that, and through chance and luck, basically wound up there in 2009, and that was 15 years ago. I've been there ever since.
It's so interesting you said about kind of the right to win. Keith Rabois said on the show the other day that the single most important question any manager has to answer is, why do the single best founders in the world choose to work with you over everyone else?
Yeah.
And I always find it astonishing how few LPs ask that. I mean, that is the question in my mind in many respects. Before we get into that and how you think about kind of picking and selecting managers, you mentioned 15 years there now at MIT. The landscape's changed a lot in that time. Is it harder than ever before today? And how do you think about comparing then and now in terms of investing in venture funds?
It's gotten a lot more difficult for a lot of reasons. I think one is, if you just think of the strategy we used to have, and I think a lot of other large endowments had for some time, it was basically sit back, see who the top 5 or 6 firms are, focus on Series A's in the US mainly. And, we had a good enough brand as MIT or other endowments and foundations to wait till these things were pretty proven. Not to mention we've been investing in these things a long time. I mean, MIT has been investing in venture firms since I think at least the 70s, perhaps even earlier. So we could be a little bit lazy and sit and wait and then get into whatever the top firms were. And there wasn't a huge number of them, right? And today, I think the ecosystem is hugely more complex, right? In terms of stage, in terms of geography, in terms of all sorts of, different business models there are for venture firms, different sector specialists and so forth. So it's just, there's a lot more waterfront to cover, first of all. And secondly, it's a lot more competitive, right? I mean, I think it's been said for a while that venture is kind of a cottage industry, or at least it was. But now, it's probably every day there's an article in the Wall Street Journal or the FT about something in venture land or startups. It's become a very...
I think Doug Leone put it well, which is that, we've transitioned from a boutique cottage industry with high margins to a commoditized low margin business.
Unfortunately.
Sadly.
Right. And so we have to try and still find the places where we can make high margins. Mm-hmm. And that's become very difficult, obviously.
I don't think we ever go back to that boutique high margin business. I think we've forever private equitized or hedge fundized. Our business has changed so seismically, and there's not a going back. Just like hedge funds are the asset allocation industry that they are, private equity is. Do you agree with me, or do you think we do get back to the more boutique industry?
I agree with you. I think this is something that only goes one direction. And of course, there will be cycles like right now, in thanks to having a bad spell the past few years, it's become a little less popular and there's a little less competition. But I think that is a secular trend. It's going to be an industry with more capital and more eyes on it.
I don't mean to push back on you, but MIT is a great name, period. Mm. Can you really not get into great funds and be a little bit sit back?
Oh, absolutely. I mean, there are several very impressive firms that we missed. And if we were to try and get in today, you never know. But I think in many cases, maybe we would be able to get in, but the check size we would be able to get would be relatively small enough that we would question whether it was worth doing. But maybe that's something we should think about. There might be cases where we would be willing to do something even with a really small check just for the relationship. But yeah, I mean, these firms, once they're discovered, and it happens early and earlier now, they rightfully prioritize their existing LPs and the people who back them from the beginning when they're thinking about who to give capacity to for future funds.
And so you go earlier and earlier down the funnel. Peter Leckide at SCS said on the show that now's the best time ever to be investing in emerging managers.
I think he's right, though, right? I mean, I think, one of the hard things is seeing who's truly dedicated and who truly wants it badly, right? And during times like this, when it's much harder to raise capital, you see which new firms really want it badly, and the ones who don't are disappearing, right? So I think that's one thing. And of course, look, at least for some period of time while we're in a down spell, there will be a little bit less competition and valuations will be better as well.
I totally agree with you there. Can I ask, which firms have you backed, just to provide some context for the listeners?
Yeah. Well, as I said, we've been lucky that we've been in this game a long time as an institution, right? So we're lucky to be in a lot of the big names you would expect, Sequoia, Kleiner Perkins, Andreessen, et cetera. And then, there's some newer things as well that we've done in the past 10 or 15 years, like, say, Greenoaks or Y Combinator, Initialized. Those would give some flavor for some of the things we do.
Great. No, it's super helpful in terms of context setting. So I do want to kind of go through the stages that we kind of invest through in funds and start with the pick. And I'd love it if we can go as granular as possible. It's a crap question, so forgive me for it. But when we think about the evaluation of new fund managers, what is it that we're honing in on? And how do we think about manager evaluation?
So I think the way I usually try to kind of bucket it into different areas for evaluation is, and I think I've heard other people say this before too, it's certainly not original to me, it's see, pick, win, right? We need people who can see the best deals, or at least a very large volume of deals, right? Hopefully the best deals are inside that set. Then we want them to be able to pick the best ones to try and invest in. And then finally, they need to actually be able to win allocation of those deals, right? Because there's lots of people who have great deal flow and who can pick the right stuff. But the final boss, so to speak, is, okay, can you get that entrepreneur to pick your term sheet over someone else who's really impressive? And then finally, I'd add service. How well do these GPs service their founders and ensure that when they're in the next competitive deal, that founder they just backed is going to be a positive reference for the next one?
What do you think is the most important? I know they're all needed to win, but actually some less so than others, respectfully.
Sure.
I know many managers, and we see it obviously in our reference data, that actually have very poor NPS and founders don't like working with them.
Yeah.
They actually continuously pick diamonds in the rough. They don't actually even see that much, but they are great pickers. How do you think about really what's primary?
I mean, I think if you're a great picker and you're not really that well liked, it can work. I mean, it depends on how competitive your space is, right? So I think in seed, that's probably more doable than in Series A, for instance, right? Although, of course, there are people who win and, you hear crazy stories about. But I would say we tend to spend the most time thinking about the winning and servicing angle, which kind of feed on each other. Because I think, look, there's at least several hundred people in the industry at any given time, GPs I'm talking about, who have good deal flow and good picking abilities. The competitive aspect forces us to focus our evaluation on those final two pieces, the winning and the picking. The winning and the servicing.
No, I totally agree with you on that kind of focus there. In terms of actually, when we think about track record, many LPs kind of place it primary. And we had Peter, again, at SES on the show very recently. You said, it's like fourth or fifth for me. Like, it's backward looking.
Yeah.
How do you think about the primary nature of track record or not?
It really depends on how mature the person's track record is, right? I mean, obviously, if we're looking at a new fund, there is no track record to evaluate. Although I would say when we back a new fund, we do probably have a bias towards people who at least have some kind of angel track record.
Totally.
And so that can give us some hints as to their taste and ability to do things. Of course, it's not everything. And someone may be in, a dozen unicorns or something from the last 10 years, but if they were only really small checks, that doesn't necessarily tell us about their ability to put a big check into something like that in the future. So, we try to, I'd say the earlier someone is in their career, the more we have to focus on qualitative or subjective things like, I don't think it should be underestimated how important just likability is, right? I think when a founder chooses someone to be on their cap table, they know it's going to be a partnership that's going to last for a very long time, right? And if they're choosing between, say, three GPs who are sort of equally credible and impressive, there may be one GP who they just vibe better with for whatever reason, right? And they pick that person. So I think that's actually, even though it sounds so simple, that's not an aspect of this to be underestimated. And a lot of the time we spend with GPs, I'm often asking myself, what kind of founder would this particular person appeal to and why? And an interesting observation I heard about Sequoia once actually is that one of the things that made them so successful was there was this period where they had Mike Moritz and Jim Getz and Doug Leone all kind of in their prime, all very impressive VCs in their own right. But interesting, they each have kind of a different flavor of entrepreneur that they would appeal to. So between having those three really impressive people who all kind of had different entrepreneurs they would appeal to, that allowed Sequoia to cover a really broad swath.
I totally agree with you. Incredibly different profiles there. In terms of I think we learn a lot from mistakes, actually. When you think about picking mistakes that you've made in the past, what did you see or not see that with the benefit of hindsight you wish you had or you missed?
It's funny. I mean, that's a question we get asked a lot, and it's hard I can't point to that many things that are like the common things that go wrong. It seems like it's kind of idiosyncratic in many cases. Everything goes wrong for slightly different reasons. I mean, one thing is just, I think sometimes we underestimate how badly people want it, right? Like, it takes a long time to be successful at this game. And I think it can be probably a slog for the first 5 to 7 years. I think the feedback loop you have to get going as a VC is you need to have some wins that make you super credible to other people, right? And then that allows you to have better deal flow, have better winning ability, et cetera. And then you have that positive feedback loop. Some people may be very impressive and have an interesting thesis and work really hard. And then for whatever reason, after 5 to 7 years, they didn't get a lucky strike, and it's harder for them to stay relevant at that point, right? Because people point at that person and say, well, they've been doing this a long time and they haven't been successful yet. Maybe they're not that good, right? But there's other people who do get lucky more quickly, and they're lucky enough to get that feedback cycle going. So I sometimes I think it's partly luck, but what are other things that go wrong? I think sometimes people.
Can I ask, in the first 3 years of a firm post backing them, what are the signs where you go, yes, I'm glad we're in there? Because the companies, I mean, respectfully, if it's in the first 3 years, they might have raised up rounds, sure, but up rounds are plenty common. There's not going to be exits. What is it in the first 3 years of a fund investment where you're like, this one's good?
Honestly, I would say in the first 3 years, you usually can't tell. Right. It would be sometime between 3 and 5 years where we start to see whether some of their companies really inflected. And we don't necessarily care whether something has had an up round, although obviously that there's signal value there. But if we see they've backed some companies that are really starting to get fundamental traction and have the potential to be iconic companies, that's the proof, right? That's what we have to wait and see. That's the only time we know more concretely that something's really working.
I totally agree with you in terms of that timeline. I spoke to Neil Mater before the show, and he said, ask him specifically for the funds which are firing, which are working really well, what are the reasons that they go sideways?
Well, one thing is, I think sometimes firms grow too big too quickly, right? And that forces them out of whatever their sweet spot was. I think another issue is, frankly, if people have a spell of success, sometimes they become arrogant, right? And sometimes they lose their intellectual honesty and their humility, and they start to make worse decisions and treat people worse and not work as hard, et cetera. That can happen sometimes and cause someone who was otherwise on a good trajectory to go sour. There's a lot of things that can go wrong. Another thing I'd point to is, honestly, sometimes people just lose their motivation, right, once they've been successful enough. And that's a key thing we try to suss out, right, when we get to know people. What is it that drives them, and how long is this really going to keep them competing at the top of their game for? Yeah,
no, I totally get you on the kind of understanding the motivation side. In terms of following your managers, I obviously speak to a lot of LPs, and they say the hardest thing is our rock star manager, I'm not going to name names, but name your great rock star managers. It's an incredible firm now and leads the firm. They've just scaled so much, and now we don't really want to follow them, not because we don't like them, but because it's a $3 billion raise, or a $2 billion raise. How do you think about that balance of, supporting the manager who's done very well, but also the opportunity cost of that cash could be put to use much earlier and higher, multiple uninvested opportunities? Yeah, it's tough. I mean, our default is always to be loyal to the people who we're already invested in, right? But I think it is a reality that in the LP business, we're always on this treadmill of every firm, no matter how great, has a half-life, right? No firm is going to be great forever. They'll eventually botch a generational transition or something, if they even try. How do we evaluate when people are getting too big? We think about things like, okay, how many great GPs do they really have on the team? How much can each of those people put to work? How much historically have they put to work per year? Things like that, which try to give us some idea of what's reasonable. And of course, sometimes people, they just go a little bit too far, and that's when we have to start scaling down. Yeah, that's challenging. How do you tell a manager that you're not going to reinvest? That's a hard conversation to have. Yeah, I mean, usually we try to know it well ahead of time and tell them relatively early in whatever their fundraising process is, but there's no way to sugarcoat it, right? That's definitely one of the least fun aspects of this job. I always say it's like firing though. It's like if there's surprise, it's probably on the person firing. So I totally agree. Speaking of the firms that kill it and scale, Greenoaks. I chatted to Neil before, as I mentioned. He said that you, in particular, and MIT put a flag in the ground for him and for Greenoaks first, which really made Greenoaks, in some ways, achieve what they have done. Can you take me to that decision? Why you backed Neil? Yeah. What you saw that others didn't? Just help me understand it. Yeah, well, it's funny. That decision almost didn't happen, and I didn't tell Neil this story until somewhat recently. But actually, when we first invested in Greenoaks, it was back during the period where we were a bit more conservative in the VCs we would back, and as a general rule, we didn't want to back anyone who didn't already have a great brand. And of course, Greenoaks at that time was raising its first institutional fund, and was not well known at that time, so it definitely didn't fulfill that criterion. And I remember actually, my boss Seth and I decided, let's leave this and look at Fund 2 or something. But I slept on it, and then the next day I decided to call
my boss Seth back and say, you know what, I think we should at least make a small bet on this to start. And we did, and it's lucky we did, because that's been one of our most successful relationships of the last 10 years. But to answer your question, what did we see in him? I think one thing that stood out even then was before he raised his fund, he'd done a bunch of individual deals, not with the fund, but sort of on a deal by deal basis, raising money for each thing. And we talked to a number of the founders that he worked with, like Baum from Coupang, for instance. And we do thousands of reference calls, right? And so we're pretty attuned and calibrated to when something stands out. And the way founders talked about Neil was, it was really exceptional relative to most calls we do. So that stood out. He had an interesting thesis at that time too on e-commerce, which was part of why we backed him, although he evolved over time and is much broader now. But, at the end of the day, it was a bet on him and Benny and a gut feeling, really.
So many things to unpack there. First, to what extent do you understand strategy shift? When a manager says, we're doing e-commerce, we're doing SaaS, and then actually a lot of it was not that.
Yeah.
To what extent is that, okay, moving with the times versus, no, that's not what we underwrote?
There's definitely a tension there, right? I mean, we want people to do what they say, but if they discover the original strategy is not likely to work, then obviously we want them to evolve, right? So I think it's about, communicating that early if you are going to shift your strategy and doing it very purposely and being clear about why.
Yeah. You said there about, sleep on it, and actually I wanted to put a small check in for us. How do you think about position sizing and building a portfolio book of funds? Like, how many is enough? How many do you want to have?
Yeah.
What does that look like?
So today, at least in the US venture portfolio, we probably have maybe 6 to 8 core relationships, we would refer to them as, where we're writing checks of like 50 to 150 million per fund. So some of those big names you would think about, right? And then after that, we have another bucket where the check sizes are typically 10 to 20 million per fund. And those are things where they may be less mature managers, and so that's why we're not writing as big a check. Or it could be that it's just a fund with a very small size, and so we just can't scale it to 50 to 150 million because maybe it's only a $100 million fund or something, right? And of course, there's often many other LPs around the table. And then a third bucket we have now is things where basically we'll write a $1 million check because maybe it's extremely early and the person had no track record, not even an angel track record, let's say, or we're doing it to work with them to source co-investments. But in terms of the number of things, so as I said, there's maybe 6 to 8 really big core things. In the middle bucket, there's probably about 20 managers today. And then in the third bucket, it's something we only started in the last couple of years. There's, I think, maybe 3 things in that so far. And we hope to put a lot more in that bucket in the future.
Okay, how much do you put out a year in terms of venture funds?
In terms of dollars, it varies a lot depending on where we are in the cycle.
Anything I can't ask you, let me know. Yeah. How does it vary, like 21 versus 23?
I think, at peak, we probably put somewhere between 1 and 1.5 billion out per year. I usually think of all of our private commitments at once, so I'm actually not certain off the top of my head what would just be the venture part of that. But to give you an illustration of how much it can change, at peak we probably were putting $3 billion out the door in 1 year, and now we're probably down to about a third of that, so maybe $1 billion.
Okay, got you. One thing that changes the deployment pace for you is the deployment pace of managers.
Sure.
We saw temporal diversification become a myth in 2021, or supposedly so. To what extent is it okay for managers to compress deployment timelines as they did? I mean, we saw many do 12-month deployments.
Yeah, I would say that's probably one of the things where we most wish people had been more disciplined, right? And when people,
I think we got too much of a break, if I'm honest, Ryan.
Yeah.
Like, LPs do not chastise venture investors more, as they should, for 12 months deployments.
Yeah. Yeah, well, it's the tension there, right, is the top VCs have scarce capacity relative to, their fund size relative to the universe of LPs who might like to invest. There's a big mismatch there, right? And so I think LPs often feel reticent to criticize people too harshly, right? But look, we all know that we were all undisciplined for some period of time, right? It's not a secret. And, virtually everyone did it. if we were going to say we're not going to invest in people who were undisciplined in 21, we would have no one left to invest in. Basically, we could only invest in new people, basically, right? So I think we have to look. We have to try and make sure that at least people are being intellectually honest about making mistakes and being undisciplined and forthright about what they learned, and we have to move on.
I mean, I did the analysis here though, and when we compare our entry price now versus 18 months ago, it's 43% lower.
Yeah,
and like of the last 9 companies we've done, that has held true. And so like, I think I'm glad, but temporal diversification does still exist.
Well, look, another thing I'd say is, as someone who works on both public markets and private markets, in the public market, if a manager went all to cash in their portfolio, we wouldn't like that either. We would say they're trying to time the market, right? So similarly, I don't think you can criticize VCs for deploying money during a bubble period, right? Now, do I wish they deployed less? Sure.
Oh, 100%. I don't think you can ever sit out. 100%. Yeah. You mentioned that kind of the public exposure and role you have. A lot of people always said about the denominator effect when publics were not performing, and it was leading obviously to a pullback on the private deployment side. How's that changed now with NASDAQ actually doing well and public looking good?
Yeah.
Has it made less pressure on private deployment?
It's certainly improved things for us. We're less liquidity constrained now than we were, say, at the beginning of last year, but the major issue still continues to be that there's all these big companies like Stripe, for instance, from the last cycle that have not had liquidity events yet. And so until some of those things get liquidity, we'll probably still be more constrained than we otherwise would be.
Is it challenging also, given your role with MIT and like actually having outflows that are, I presume, required in terms of scholarships and maintenance and everything involved, which is incredibly important, obviously, but a lot of LPs don't have mandated outflows that have to be made. Is that difficult because you kind of have to project forward into unknown times and you don't know what you're going to need when?
It certainly makes it a more tricky situation, but we have a lot of ways of modeling this, right? And for the most part, we're able to be pretty consistent in the check sizes we put out. I would say the last 2 years are unusual because of this dual problem of, one, we normally assume all our managers are going to raise every 2 to 3 years. And there was a period where basically everybody deployed a fund in 1 year and then raised again right away. So that was one thing. And then secondly...
And doubled in size.
And this crop of big companies has taken much longer to achieve liquidity than we expected. So I'd say there was sort of an unusual effect there in this cycle. But normally we know we have to pay out about 5% of our assets per year to support our institution. That never really changes. We have a smoothing formula for that, but that's pretty consistent. So we generally know what we need to do. It's just, I think this is a very unusual period.
Yeah. How do you think about the liquidity challenge? We mentioned Stripe there. There's many others, your Databricks of the world. We have this whole generation of companies now. It's almost formed a new economy of like pre-IPO, but should be IPO companies in many respects.
Yeah.
How do we answer the liquidity question? I'm sure you get it from Seth and from other people, but what's the answer? There's a lot of companies waiting.
I mean, there's not much we can do, strictly speaking, right? I mean, there's some cases where maybe, particularly if there was a co-investment, we could encourage the manager to sell some secondary or something. But there's not much we can do, right? We're waiting like everyone else for these things to IPO. And I think another thing we're concerned about, of course, is with a lot of these companies, so much of the cap table is owned by investors who have been there a long time and maybe obligated by their fund lives to get out. It's anyone's guess what's going to happen to the prices of these things when the lockup windows expire, right?
Do you ever think about selling positions in managers? We often hear about managers, getting out and getting liquidity. Do you ever think about actually selling positions in funds?
We'll certainly think about it. We almost never do it because we're not willing to do it at a low price, right? I mean, the reason these secondary funds exist is obviously to get high IRRs themselves, right? And so generally speaking, if we're selling a package of something to someone smart and they think they're going to make a 20% plus IRR, that means we should probably just hold these things, right? So luckily, we've never been in a dire enough liquidity situation where we had to do that, right? I think we would only do that if we were really forced to.
Yeah, no, I totally agree. I mean, we've seen 80% discounts on some.
But look, if we can get a good price, certainly we'll think about it. But it's just that's virtually never the case.
You said about the third bucket being, sometimes people who can provide good directs. You mentioned Coupang earlier. I know that you're very active in terms of direct investing. Why is that such an important part of strategy, do you think?
I think there's a number of things we like about it. One is just, if you can have another tool in your toolbox for making good investments, why not build that up, right? Secondly, I personally find it easier in a lot of cases to write a big check to a co-invest than to a blind pool fund, right? Because no matter your conviction in someone, when you're writing them a blank check, we don't know what's going to happen, right? And as we've talked about a little bit, even with people who have a really good track record, you can't fully predict how they're going to do with that next check, right? But if we have an opportunity to invest in something that we know is a great company today at a reasonable valuation, and sometimes with a really great structure around it as well, I find it much easier to have high conviction in that.
What do you mean by a great structure around it?
Well, so for example, Neil might have mentioned the Coupang case. Most of the money we invested in that was in this special structured note where we felt it had very protected downside, but managed to keep a lot of the upside as well. So it was very easy to have high conviction in that situation.
How do you protect the downside in that way?
Well, basically, it was a note where it was the most senior thing in the capital structure. And of course, we had a view about the minimum future EV of that enterprise, right? And relative to that, it was very small. So it was very tough for us to envision a scenario where this thing got primed and we didn't at least get our money back.
Yeah. Now, how do you think about the decision-making process and the underwriting process on the direct side? Because I see a lot of actual kind of LPs make the mistake of not doing the work and not trusting the manager and kind of just falling in the middle, where they kind of have someone half the time kind of check out the company and it's just done poorly. They meet in the messy middle.
Yeah.
How do you think about the underwriting process?
Well, ideally, we do like to get to know these businesses. And so ideally, we like to get to know them well ahead of time. And in the case of Coupang, for instance, when we first got interested in it, it was when we did a reference call on Neil with the company. And we're very impressed with Bomb. And that was something Neil actually invested in before Greenoaks won. And so we were kind of, disappointed actually that we were investing in this new fund where it was not going to have that exposure, right? And so we told him, if there's ever an opportunity for us to invest alongside you in this company in the future, let us know. And sure enough, within a few years after that, Neil did see there being a potential opportunity to put the structured round together and let us know. And, we had enough time to go visit the company in South Korea and tour some of the warehouses and things like that, get to know Bomb a little bit better. I'd also say I think we had a prepared mind because by that time, obviously, we'd seen Amazon work in the US, right? We'd seen some other things in other countries like, say, JD in China or Flipkart in India turn out to be interesting as well. So that was some of what turned us on to the opportunity. And in that case, we were able to spend quite a lot of time getting to know the company, getting to know the financials, getting to know the structure, and really being thoughtful about it.
Okay, so we know then we want to invest. How do we think again about portfolio allocations and sizing on a per position basis?
It depends on our liquidity at any given time, but there's a huge range, honestly. So in the case of Coupang, that was 120 million co-investment for us. We made, I think, a distribution price is 7 to 8x or something like that. It's probably a little lower now that the stocks come down a bit, but that was a large outcome for us, obviously. Sometimes it's constrained by what we can get. I mean, there's another opportunity where we co-invested in Snowflake before it IPO'd. And in that case, we were only able to get a few $1,000,000 allocation, even though, given what we knew about the company, we would have invested a lot more if we had the opportunity. But I'd say it's a wide range. If something's earlier stage and less certain, doesn't have as much structure, it may only be a $5 million
I
check.
may be veering into completely dangerous territories here, but why not? Are the incentive structures financially right in endowments? What I mean by that is 120 million 7-8x. That is a huge amount of carry if you're in a traditional fund structure.
Sure.
Do endowment funds have the financial incentive structure right?
I mean, honestly, I think the answer is no. Right? I think we're able to do what we do because I have to give credit to our CIO, Seth. He's created a culture where people care about doing these things and want to do these things. And I think also it helps that because we had a period of success, I think we had, we built up enough credibility in our own situation to feel comfortable taking some of these risks, right? But yeah, I mean, the traditional endowment or foundation, I think part of the reason they're not good at this stuff is they don't have an incentive to be, right? And people, when they don't have an incentive to take risks, they're not going to want to stick their necks out.
What's the right way to do it? If you were to construct a family office, I give you a blank canvas. How do I create an incentive structure that allows for people to be really motivated, take risk on manager evaluation? We see this commonly between us, but like a lot of the firms that exist today, we're not excited necessarily about moving forward, but you definitely won't get fired for putting money in X firm.
Right.
How do we move away from that, and what's the right incentive structure?
Well, it's tough. I'm of two minds on this, right? Because I think the reason there are good reasons for endowments and foundations to have the incentive structures that they have, because something that the governance is typically concerned with is they want to make sure things don't go awry, right? And they don't want to give people, a free option on an institution's capital, right, by giving them carry necessarily. So, there's good reasons to do it the way it is done, but if I had a blank sheet of paper, if I were running a family office, let's say, I would probably do something where, one, people would be required to invest a lot of their own money in the investments the firm was making, either money they already had or a large portion of whatever their bonus might be. And I would probably say, yes, there has to be some kind of incentive structure, maybe over a suitable hurdle.
Yeah. Can I ask, on the direct investing again, in terms of pricing, matters a lot. We lost price sensitivity for a lot of managers. When you think about your lessons over 15 years, how do you reflect on your relationship to price when doing directs? And what are you looking for? Is it a 3x? Is it a 10x? Is it a...
Yeah, I think it's a tough question, right? I mean, obviously, we're all weighted a little bit to what we see happening in the public markets at any given time, right? And I think at one point during the peak of the bubble, we were weighted to much higher exit valuations than we should have been. We made mistakes like everyone else. I would give ourselves some credit for, at the peak of the bubble, we said no to several co-investments where people that we really respect and still respect were pounding the table to do these things, and we said no.
Do you worry that they won't come back to you if you don't do them? I've had this with quite a few LPs where they say, like, we'll do it if you won't bring us the next one, like if you need us to.
Yeah.
And I'm always like, you don't have to do something you don't want to.
Yeah.
And that's fine. But do you worry that if you don't, they won't come again?
It's always a concern. But look, I think you have to be disciplined at the end of the day and say no to things that are marginal uses of your capital. And, could there be a few cases where we can be helpful with a smaller check for something that's right on the margin for us, but a big deal to that manager? Sure. Occasionally we might do that because we think overall it's NPV positive, right? But I think another thing that keeps people coming back to us is we're probably one of the few LPs, certainly one of the few university endowments who can react to one of these things very quickly in big size. I mean, I talked about how in the case of Coupang, we had quite a bit of time to look at it, but there are other cases where, with Neil, for instance, I think there was a big article maybe last year about the deal he did in Rippling, right? And that came together over a weekend, right? During this bank collapse period.
Are you able to take me to that?
I probably can't talk about it in detail, but the point I'm making is that within a few hours, Friday night, we made the decision to back that deal. I don't think there's many LPs who can do that.
How do you decide in that way? I don't know if you can go into the decision-making process, but that is an incredibly compressed timeline. I don't know any that can write that size check in that time frame.
Well, we didn't write the whole thing, to be clear. Yeah, I mean, honestly, Neil probably had several other, several of Neil's LPs are very good, and I'm sure there were others that participate as well. In a situation like that, a lot of it is trust, right? I mean, we trust Neil's judgment, but also that was another case where the structure was fantastic. We knew a lot about the company already. We had several other people we know who had a really high opinion of Parker. So I think we had a prepared mind for it as well. So it was a combination of, we had a prepared mind because we knew about the company and the founder already. We had a lot of trust already in Neil and his team. And thirdly, the structure was really fantastic.
Can I ask, when you think about the direct investing mistakes, you've had 15 years, I'm sure there's some. What have you learned from the ones that haven't worked out?
The worst that I've been involved in, at least, was an oil and gas investment.
Can I ask what happened?
Well, basically what happened was, so there was an oil cycle, right? And there was a manager we were invested in who was very good at doing this play, basically, where this was sort of, I don't know if I would say towards the end, but basically there was this thing they could do for a number of years where, as you know, right, shale technology has really improved and innovated a lot in the last 15 years. And there was a period where it was a relatively new thing to be doing horizontal exploration of certain oil plays. And so they found this interesting area where it had been vertically explored with vertical wells, but not horizontally explored, which could really increase the yield of oil you could get from the acreage, right? And because it was vertically explored, they had a pretty good idea from looking at those wells where things would probably work and where they wouldn't. But the bigger buyers of these parcels of acreage typically wouldn't give you full credit. So what these guys would do is they would buy the stuff that hadn't been horizontally explored, like a large parcel, and then they do a few wells here and there, horizontal wells, to prove it out, and then they would flip it for a big MOI, right? Anyway, there was a period where there was a big oil decline, and they found a new place they thought would be good to do that. And it did work out initially, but then the problem was actually it was so successful that it was very hard to flip this package because it got so big, right? I mean, this thing was worth, I think, well over $1 billion at peak, and at peak it was probably like a 5 to 7x for us. And anyway, so the way they wanted to exit it was they ultimately merged it with another small public company that had complementary acreage. And then we just had this perfect storm of, new CEO. We had an oil price decline after that. They drilled a few bad wells as well. The company they merged with had a fair amount of debt already. And so things just spiraled down, right? And so you could say, look, what did you learn from that? You just, everyone knows not to do commodity-oriented things with high leverage and all these other potential problems. At least as it relates to venture capital, I think one of the things I learned from that is I think we didn't appreciate how brittle these small shale businesses can be, particularly if you're going to not just flip acreage, but actually try to fully produce it, because the decline rates on these wells are so high. Even though on a well basis they can have high IRRs, the decline rates are so high. If you're trying to really maximize production, you have to basically reinvest your whole balance sheet every year. And even if someone is really good at that, let's say they get it right 80% of the time. Well, 0.8 times 0.8 times 0.8 times 0.8. After 5 years, you're starting to face pretty significant probabilities of a big loss, right? And so that's, in some ways, I think that's what happened there. And, what is my takeaway? You have to be very careful with businesses where you have to reinvest the balance sheet every year. You have to continuously reinvest the customers, right? So other parallels I sometimes notice, things like gaming, where maybe you have a very high churn rate in the customers, right?
My friend just bought a sports team.
Yeah.
With his private equity fund from several $1 billion. He said, the thing I didn't expect, it costs $500 million to keep this fucker running every year.
Yeah.
And you're like, that is different.
Yeah. So, that's an example.
Knock your confidence? Because I think that, I spoke to Doug Leone actually in the show about this. Like when you have a loss, or not a loss, but something that does not perform as expected, it can hit your confidence. And the winners are those that, as you did, is like pick yourself up, on we go.
Of course, it hurt me a little. I mean, I think I was lucky that I had some other successes I was involved in by then. So it's not like, that was the only thing I'd done and then it was a failure. And I mean, I'm amazed actually. I think on that particular deal, we still recovered about a third of our capital or something like that. So it wasn't a zero, but you always, it impacts you a little bit, of course. But luckily things have been fine since then.
Has your investing style changed over the years? 15 years is a long time. Has how you think, how you prioritize, what you prioritize changed?
Well, for one thing, I personally spend a lot less time on the public markets than I used to. Actually, when I started at MIT, I was mostly doing public market stuff, but I'd say in the last 7 to 10 years, I've sort of switched to doing mostly private stuff. I just find it much easier for me and my personality to, I think, generate alpha on the private side. I mean, the public side is always becoming more competitive. If you think venture is competitive, try making alpha versus the NASDAQ, right, as a public manager. That's incredibly difficult to do on a consistent basis. That's one thing that's changed for me. I think another thing is, I think after seeing things play out over a couple cycles, I trust my judgment a little more, right? I mean, there are things that happened during the peak of bubbles where, you didn't think something would do nearly as well. Maybe there's something you passed on, right, for good reasons, and then it does incredibly well. And, it's rather confusing. But sure enough, these things eventually come down to earth.
Very well.
Well, it's funny you asked that about some of my mistakes, right? Because actually the biggest mistakes are actually errors of omission of things that did really well. And probably the number one thing I think about right now is I mentioned we're investors in YC, and when Sam left YC, around then we also had an opportunity to invest in OpenAI, and we didn't do it. So that's definitely an area of omission that I think about a lot. A couple of things. I mean, one, it was a very unusual structure, as people now know. Two, it was unclear how they were going to achieve success technically at the time. We felt that it was a very speculative bet at the time, and but I think that's the case where we should have said, look, we know Sam, we know he's a special person. This is a huge idea. Make a small bet.
Can I ask you said there about kind of the speculative nature of that. How do you actually think from a portfolio, and sorry for being broad, but it's really from a portfolio level of like how much being publics, how much being privates, what cash looks like, and the right level of risk profile to have across the actual whole portfolio?
Yeah. So ideally, we want to be probably about half publics, privates. We typically carry anywhere from 5 to 10% in cash and short duration government securities. In terms of total risk, I mean, probably one of the main ways we think about it is we have a concept called drawdown beta, where essentially if the market is down 10%, we only want to be down, say, not more than 7.5%. So we try to keep it 0.75 beta or less.
Are you seeing less managers coming back to market now?
Absolutely, yeah.
Are their fund size expectations changing?
Yeah. Happily, they are smaller.
How do you think about deployment now? Everyone, I think the media in particular likes to present a very gloomy environment. I don't always agree with it, and it's not actually what I'm seeing necessarily. How do you think about deployment today? And do you think LPs are closed for business? People
are not closed for business. I think people have to do things in smaller size or might not be able to do as many new things as they would otherwise like. But I think especially for the firms that have top reputations, I don't think they're having that much trouble raising money, right? I think they always have more LPs who want to invest than they have capacity. So I don't think the top firms are hurting in that regard. I mean, maybe if they try to raise too much, they'll get more pushback than normal, more critique, which maybe is a good thing. I think it's the smaller managers or the emerging managers that are going to have a lot more trouble raising capital in this environment.
What would you most like to change about ventures today?
Well, I would like it to be less competitive. I don't think that's going to happen.
For managers who are contemplating raising today, what would be your biggest piece of advice?
I think you have to treat the process like an enterprise sales cycle, right? Which means you need to think of it as a numbers game, and you need to have a funnel.
I actually say lines, not dots, which is Mark Suster's comment. Which is
interesting.
Like, you have to build relationships over time. If you think you're going to meet someone in a fundraise and raise, you can do. But it's rare.
Yeah, and another piece of advice I'd have on that is that it's good to build relationships, but you don't necessarily want to force people to evaluate you too early. Because I think, particularly with larger institutions, it can be the case that once they evaluate you once, they may not be willing to look at you again, right? And so if you come to them at a point, particularly if an LP is very picky and usually does very mature things, you don't want a situation where you get them to evaluate you prematurely and then you're permanently written off. I mean, no one's ever permanently written off. That's a bit dramatic, but if you can, I think it's good to know who you're trying to raise from, what's sort of their sweet spot, and don't try to keep them from doing that full evaluation until you're really at the right point to be evaluated by that person.
I think a lot of managers also struggle when it comes to kind of cap table construction of their funds, and there's a lot of advice thrown around about LP concentration. Don't let anyone have over 20%. There's a lot of different aspects. When you think about advising managers on how to construct the ideal LP base, what would you say?
Well, one, I think you probably don't want to exceed 10 to 20%, except in very unusual circumstances. I think part of it is just what kind of business do you want to run, right? Obviously, if you have a large number of LPs, you shouldn't underestimate the time that it takes to manage those relationships, right? And if you're going to have, say, hundreds of LPs, you may need, some people in your business who are dedicated to managing those relationships, right?
Do you mind that? I find IR teams respectfully, and there's nothing against them, but they just create a layer that removes from the human relationship with the GP. Yeah. I think it also impedes your ability to get good directs because you lose that messaging with Neil or messaging with whoever that is. Are you turned off by IR?
It just depends on how it's done, right? I mean, I think there are some people who do a really good job at it, and they manage to thread that needle of protecting the time of the GPs who you want focused on their main job, right, which is investing, but still, manage to keep you updated and what's going on and can get you access to that person when you occasionally need it. And of course, something we try to do as LPs is not be overly demanding in the time we take from people, right? We're always very conscientious of the fact that we want most of these people to be spending most of their time out on the field, right? Chasing the best deals and not, with us or other LPs.
Yeah, no, I get you completely. Can I ask, I've spoken obviously to many over the last few months, and a lot of them regret activity in China. Mm-hmm. How do you think about China today moving forward? Any lessons?
Well, it's something we're wondering about as well. It was an area of great success for us for some period of time. We're definitely, I think like many others, we're doing a lot less there now. We're not going to categorically not do it at all yet, but we are reducing it. And to the things that we keep doing, we're very careful about whether they're people that we think are going to keep from sensitive areas of investment, right? And obviously also we don't know how these regulations might change in the future. So that's another reason to keep it small.
Yeah. Final one before we do a quick fire. When we think about firm building, generational transition is often the place where many people and many LPs in particular say that's where firms fall down. You said most people botch at least one generation.
Yeah.
What do the best do to ensure generational transition is done well in your kind of purview and experience?
Yeah, it's very hard, right? I think the reason it's hard is just because it's unusual to have exceptional people, and then it's very hard to find the next generation of exceptional people, right? It's hard to make lightning strike twice. And then of course, the bigger your firm is and the more GPs you have, in some ways it gets exponentially harder, right? If I was lucky to have 3 really good people, it's extremely difficult for me to have another cohort of 3 really good people come up next. But the people that do it well, I think one, they're very thoughtful about it. They're very thoughtful about mentorship and making sure that the next generation of people has the right skills to be successful. And I think also they're thoughtful about how they share economics, and they don't wait too long to do that. And I think one of the reasons a lot of firms sometimes lose some of their best people is because they don't do that quick enough.
Yeah, no, I totally get you. One thing I do have to ask, and I promise we'll do a quick fire, but is, we've seen this generation of firms really scale up and really become capital accumulators, asset gatherers, some people say. Do you want to be in those firms? And I think when I speak to many LPs, they're like, I'll still get a 3x. And I'm like, if you think you're going to get a 3x on a $3 or $4 billion fund, either I'm being too negative or you need to wake up.
Yeah.
How do you feel about this?
Certainly the probability of hitting a 3x is much less. Look, I think in some cases we can still justify it. But yeah, if a firm gets too big and we're no longer confident that we can make exceptional returns, over time we're going to have to scale out.
Yeah, I get that. Okay. Listen, are you ready for a quick fire?
Sure.
So what have you changed your mind on in the last 12 months?
Probably hard tech. I wouldn't say I've completely changed my mind on it. Not to say I have a really hard set view either way, but I think I used to be much more skeptical of them, and I think the existence of things like Tesla and SpaceX and Endural have forced me to reconsider some of my biases.
So you are inherently more positive in hard tech investing?
I'm more positive now than I was in the past.
Okay. Do you need to be a specialized firm to win?
I don't think so.
That's a good one. I wasn't expecting that. What do LPs do today that we'll look at in 10 years' time and think, wow, I can't believe we did that?
Something I chuckle about a little is just how pro-cyclical people are. And, 2 years ago, everyone wanted to do lots of late stage and solo capitalists and crypto. And then, a year later, they all think it's dead and don't want to do that ever again. I think most of those things will come back.
What won't come back?
That's a good question.
I don't think, I believe in crypto,
yeah,
but I don't think NFTs will come back.
Even there, I don't want to be totally closed-minded, right? A lot of something I think I'm always humble about is a lot of the things that have turned out to be the best businesses are things that many people would have thought were totally crazy.
Yeah.
So I don't use NFTs myself, but I don't want to completely close myself to the notion that something there could be successful.
So what won't come back?
This reminds me of, I think it's a quote from the Andreessen folks. I think they say something like, nowadays, when an entrepreneur comes in and tells us a crazy idea, we assume they're right. It's just that their timing might be off. And I tend to follow that as well.
Yeah, they also say there's no such thing as a bad idea, just a bad time.
Yeah.
Yeah, I like it a lot, and I agree with you. What would you most like to change about the world of LPs?
Tough question. Yeah, I don't think I have a good take there. I'd have to think about it.
What would I change? I would change box ticking nature.
Well, that's not going to change. At least not for the majority.
But actually, the best definitely don't show it. Do you know what I mean?
Well, yeah, I think the best don't follow that.
Heritage, I think about Harvard, it doesn't feel like a box tick.
Yeah.
When you meet fund of funds, it's like...
Well, look, I mean, that's what makes some of these groups special, right? They're able to get beyond that.
Yeah, no, I totally get you. What was the best AGM you've ever been to?
Tough questions, Harry. Honestly, most AGMs are kind of the same.
Are they pretty boring?
I mean, they're often, depending on the firm, they're often highly produced. It's always useful to get some time talking to people, right? But look, I think, a lot of them are probably longer than they need to be.
What's the best investment advice you've received?
When things are going well, you're never as smart as you think you are. And when things are going poorly, you're never as dumb as you think you are either.
What advice do you give most often to other LPs?
Well, I mean, honestly, we don't talk to other LPs that much. No, we try. There are some, of course, right? But we try to stay independently minded, right? And I think the more you talk to other LPs, the harder that is to do.
I totally get you. Which manager are you not in that you would really like to be in?
Probably Founders Fund.
Why are you not in there?
I mean, that's a case where when they got started, just, no one from MIT spent much time with them. And I think now at some point it just felt like it was too late.
What makes Neil Mater so good?
I think it's a combination of his ambition, his great judgment, and I think he's managed to be very likable and useful to his founders.
Yeah. What do you know now that you wish you'd known when you started your career at MIT? The joys of podcasting is there is time.
Yeah. All right. Yeah. Well, I think what I wish I understood better, and I'm always developing more appreciation for this, is just your scarcest resource is your time. Figuring out how you're going to allocate that is really the first constraint you need to figure out, and everything else flows from that. Yeah.
What's the hardest element of your job? Other than time, everyone says time.
Well, I mean, the thing I dislike most, of course, is having to disappoint people, right? Because for every 100 meetings we take, right? I mean, we might only invest in one thing, basically. So that means disappointing a lot of people. Yeah. And of course, it's even harder when it's someone that you work with potentially for many funds.
Yeah, no, that's really hard. Where would you personally like to be in 10 years, Ryan? When we have this in 2034, Christ. Where's Ryan then?
I'll probably be doing something similar at MIT or a family office or something similar.
Listen, Ryan, I've loved this. I really appreciate it. I think not enough light is shone on this area of the industry. I so appreciate the transparency, and thank you for being so good.
My pleasure, Harry. Thank you.